And I think when that happens, that's when you see silver go berserk and catch up for the error of the past 50 years.
Well
My
said.
suspicion, where do I think silver might be in six months? Well over 100, maybe 200.
Silver can run as far as it needs to run now. Now, they're not going to just let it run completely, like I said, but silver's not going back to the days of $25 silver. It's just not going to. It's going to continue to run. The governments around the world are going to try to continue to manage it. If you like gold and silver, buy more when you have these dips. That's a perfect time to get in.
In a compelling discussion, market analysts Michaeloliver and Robert Kientz shed light on what could be one of the most dramatic moves in the precious metals market in decades. They believe silver is on the verge of correcting half a century of undervaluation, and when that shift happens, it could be explosive. According to the analysis, silver's days of stagnating around $25 are likely behind us. Once momentum builds, the metal could soar past $100 and potentially reach $200 within the next 6 months. This isn't mere hype. It's a reflection of deep-rooted market imbalances, relentless monetary expansion, and increasing investor demand for tangible assets. Governments may attempt to manage or suppress prices, but fundamental forces appear too strong to contain indefinitely. As the monetary system continues to strain under inflationary pressure, silver could finally catch up for the error of the past 50 years, signaling a massive revaluation event. For investors, these potential dips in silver prices may represent rare buying opportunities rather than warnings. As global uncertainty rises, the message is clear. Precious metals remain one of the last lines of defense against a devaluing currency. If you found this insight valuable, don't forget to like, share, subscribe, and comment below with your thoughts on where you see silver heading next.
So in the short term, this can be very damaging to precious metals investors, and it can be very frustrating. But one thing that I wanted to point out, if you look at the longer term, gold has been in a 25-year bull market. Silver, not quite 25 years, but it's starting to follow as its younger brother. And silver has a little bit more explosive upside because it's used more industrially. So we're actually running shortages from what the mines are producing to what we actually have. So I think the silver situation is going to come to a head faster than the gold situation. But the good news is, over the last 25 years, gold has followed very closely the CPI index over that period of time. Now, most of us don't believe that CPI is the real inflation rate, but the traders do pay attention. So even though I don't want people to panic, because even though we have all of these factors going on, and it looks like gold has this $300-400 fall, and silver has, $4 or $5, $6 fall in a very short period of time, a lot of that is just rebalancing. It's rebalancing, one, the futures trade and the OTC trade in London. Two, it's rebalancing the risk of London not having enough silver and the COMEX sending bars over to help bail them out. And three, it's rebalancing ahead of these trade deals and other deals that are going on in the economy. And four, the sovereigns don't want gold and silver to run too quick because they're not ready with the CBDCs. So what they're trying to do is manage that trade.
Starting in about 2015, if you plot the spread, divide gold, ounce of gold into S&P price, and plot it month to month, percent, you've been in a basing range where at the top of that range, the gold performance will surge up to a given level and stop, come back up to a similar level, stop, and has built a beautiful trend line going back 11 years with 4 pivot points hitting it. Intra-month this month, of course, we have, 3.5 days left. We've been out above that breakout point. We backed off hard last week, when we had the drop in gold and silver, and I don't know how we're going to end the month. But if the gold is 60% of the price of the S&P, it's a major breakout. It's telling you, I'm gone. Okay, it's going to break out. Now, when that spread breaks out, the net price of gold it's just the beginning. That spread is telling you at that point in time when you break that spread out, and if it doesn't happen this month, it's going to happen soon. I can tell.
Yeah,
it's telling you it's a new game.
Yeah.
It's not an old trend. It's new.
When you see silver breaking $50, that automatically sets off alarms with authorities saying, wait a minute, we don't want that to get too high for 2 reasons. One, they use a lot of silver in everything, including missiles, medical, all that kind of stuff. The U.S. government, as I've been expecting for many years, named silver a critical mineral this summer, and the U.S. government just spent $4 billion in $1.5 billion of that buying silver for its own coffers so it can feed its military and other uses that the government uses, and $2.5 billion of that goes into the development of new silver mines and new silver processing here in the United States. Trump also just recently agreed to an $8.5 billion deal with Australia concerning rare earths, and several billion of that is going to go into rebuilding the supply chain, not only buying the rare earths, but building the supply chain to get off of Chinese dependence on processing, which they hold over 90% of processing of most critical minerals in the world.
You prefer to sell when everything's great, and yet it goes down anyway. Like maybe this week, we got Trump maybe making a deal with China. Oh boy, that problem's out of the way. 2, the Fed's going to cut again. Oh boy, we have a trend. So it's happy time. Wouldn't it be interesting that after those events occur this week, and both thumbs up, let's say, that suddenly then the market starts to wobble? When everything's good, why should it do that? That's the better time. We think we're still in that process of topping, even though we've made like 10% new highs in the S&P, above where it was in January, February. Similar action again occurred in 2007. So it's not unusual to make a high, start to break, momentum says you're no good at that point, go up, make a new price high, momentum laughs at it, and then you finally roll over. And I think we're in that process. So I would not want to own stocks. Okay. I would focus on real world assets and companies related there too.
So as you look at the meetings that are going on around the world with Trump and other people, Trump and Xi Jinping, for example, in China, Trump and the Japanese prime minister, which you just had, and also Trump and the resource deal they did with Australia, there's a lot of expectation that gold and silver prices don't need to rise too high because of those deals. And if you look at the traders, when you have this extended any sort of extended downward move or upward move like we've had in gold and silver the last year and a half, traders will want to reset their positions for the next futures contract. So all in all, a lot of this is just repositioning until the end of the year. And some of it is repositioning given what's going on in the markets with regard to trade. Now, also, we have Fed meetings going on yesterday and today, which are going to dictate whether the Fed lowers interest rates again. They just did at their last meeting. I believe it was a quarter point. They may lower it again this year because in the Fed's eyes, inflation's come down a little bit. And even though the job situation's not great, it's not enough concern that they would want to raise interest rates. They would want to lower them to spur the economy just a little bit because they're concerned about jobs. And so because inflation is lower than it was, say, 2 years ago, the Fed's expected to continue to cut interest rates a little bit to avoid what would be an official recession in the government's eyes. Kind of take all of those factors into account. It was time for gold basically to cool off a bit. The long-term trend certainly is higher, but I'm not sure that the world is ready for a much, much higher gold price because it points to the issues with the fiat currencies.
In a detailed market analysis, experts discuss the recent turbulence in gold and silver, explaining why investors shouldn't panic despite the sharp drops seen across both metals. In the short term, the pullback may feel painful, but it represents a natural rebalancing between futures, physical markets, and sovereign management ahead of trade and monetary policy shifts. Over the long run, gold has maintained a strong 25-year bull market, steadily following inflation trends. Silver, its industrially vital counterpart, appears ready to accelerate faster due to widening shortages and increasing government interest. The U.S. recently named silver a critical mineral, allocating billions toward domestic mining and strategic reserves, a sign of how essential the metal has become for defense, technology, and energy systems. Meanwhile, the global economy faces a complex dance of trade agreements, interest rate adjustments, and supply chain shifts away from Chinese control. As central banks and governments work to balance growth and inflation, precious metals continue to quietly prepare for their next major move. Short-term pain may simply be the setup for long-term gain, positioning gold and silver investors for potentially powerful advances ahead. Let's get into the interview.
Right now, gold has been as good an investment over the last 5 years as Bitcoin. So people who claim Bitcoin's done better are wrong. It's flat. And we're arguing it's about to break down. Now, the problem with Bitcoin breaking down is this. It's no longer just some off-to-the-side market. It's too many companies are up to here involved in crypto in one way or another, such that when that asset does break, and we think it'll break sharply and crash-like, when that happens, it will ambush companies that have nothing to do with crypto and yet do. Hence, it will hurt the stock market. It will be like a torpedo they're not looking at. They're all looking at what's NVIDIA doing. If it's okay, everything's fine, right? Well, watch the financials and watch Bitcoin.
And the one thing for precious metal stackers to understand, especially if you're new to this space and you're just learning, it's not dependent on the physical trade at your dealer or from APMEX or from Miles Franklin. It's really dependent on these derivative markets that sit on top of the precious metals. So just because the precious metal price comes down, you have to look at these other intervening factors more than you do what is the worth of your metal in dollars. And the last thing I'll say, and this sort of extended answer to your question, is at the end of the day, while we measure precious metals in dollars or pounds or yuan, at the end of the day, with Basel III elevating gold to a high quality liquid asset on par with cash and bank stock at the central banks, really eventually we're going to measure everything in gold. And that's why the central banks have been buying so much gold. And when they flip that switch to CBDCs, they're going to reset the gold price in the US and around the world to capitalize those CBDCs as the new currencies and to allow them to write off all the old debts. That's why Judy Shelton was on Twitter this week saying that we should do a gold-backed treasury, because what they want to do is back the treasurers with gold when they're ready to do the CBDCs, reset the gold price, and bring all of that debt down or write off a lot of that debt using the nation's gold and other things like cryptocurrencies and Bitcoin.
When you go back and look at that explosion we had in late 79 to 80, where silver had already been going up for years, and suddenly it went berserk. It like quadrupled in 6 months. Or in late 2010, about 6 months before it hit its peak at 50 in April 2011, silver had already been going up for years, and suddenly it went berserk. It doubled in half in 6 months. If we do something similar, the thing that told you back then that it was going to go berserk was the spread. Silver was already full thumbs up, momentum-wise, but what told you that I'm going to lift the lid off in relation to gold? It was the spread. It had similar structural ceiling on it. It broke through, and at that point, the spread said, I'm going to explode. We're facing that door right now. So that's the technical we're watching, not the price or the momentum of price.
In today's markets, gold has quietly matched Bitcoin's performance over the last 5 years, despite all the noise surrounding crypto. But while Bitcoin faces increasing pressure and a potential sharp breakdown, gold continues to strengthen its long-term position as the world's ultimate financial anchor. The danger now lies in how deeply intertwined crypto has become with the broader economy. When the digital asset market cracks, it could ripple through companies and sectors that never thought they were exposed. Meanwhile, gold's relevance is rising behind the scenes, with Basel III elevating it to a high-quality liquid asset equal to cash in the eyes of central banks. Gold is reclaiming its place at the foundation of the financial system. As central banks accumulate massive reserves, many analysts believe this is preparation for a future reset tied to the rollout of CBDCs. When that moment arrives, gold's revaluation could rewrite the balance sheets of nations and wipe away staggering levels of debt. For investors watching the horizon, the signal is clear. Gold isn't just a safe haven, it's becoming the new measure of value in a changing world. If you found this insight useful, don't forget to like, share, subscribe, and comment below. We'd love to hear your thoughts.